Hey, welcome to the Victor H Investing live stream. I'm Victor, and in this live stream, we will be covering stocks, including the plan I have this week for the stock market, kind of review where we're at, and kind of go into the week with a plan that I can execute this week. Not sure where the stock market's going to go. We are in an expensive stock market with prices being fairly high. And there isn't any big news that could really drive the market. There's no big Federal Reserve meeting or anything like that. There is just a couple bits of news that could affect the market. There's no big earnings reports that are coming out with one of the big gigantic companies. So I think it might be a week with very little news. Now, keep in mind, some of the corrections and pullbacks that oftentimes happen when nobody expects them. It was kind of unexpected and boom, it just starts to sell off, or a pullback, starts. It's usually when investors are really comfortable and this Mr. Market, surprises everyone and starts to sell off. We'll see. We'll see if that happens, when it happens. I'm not sure. All I know is I evaluate companies. I'm always looking to buy more shares in companies that I think are discounted. And no matter what market we're in, there's always companies that are discounted. We had a live stream yesterday, and I really liked the question of, hey, what companies are out there that everybody hates, maybe dislikes, and are discounted? Those would be good companies to look at, because in the short term, the stock market is a voting machine, voting for the most popular company. AI stocks are a good example. That AI stocks are just, on a tear, very popular. But over the long term, the stock market is a weighing machine, and it weighs free cash flows. It weighs profits. It weighs fundamentals. And, I'm looking for companies that maybe are not very popular, but are very valuable. As I get into the live stream, just a quick reminder, I'm an individual value investor, just sharing my experience with you and my point of view. I don't recommend you buy or sell any of the stocks that I'm going to talk about, and I do not provide any financial advice. With that, let's get into it. Thanks for joining. I see a couple of people on. Please ask questions or let me know if there's a stock you wanted to zero in on, and we can kind of talk about. And please, we had great comments yesterday on the live stream with Scott, with Scott's Due Diligence, and really appreciate how many comments came in. It was a really, really good session. So let's make this one the same way. All right. So this week, looking at what's going to happen from, information standpoint. Again, not a lot of information that could move the market. There's a couple of, speeches with Federal Reserve presidents that could move the market a little bit. I guess the biggest one being jobless reports are coming out on Thursday, but I'm not expecting any big news there. The market is, on a nice, upward trajectory. The momentum has been for the market to go up higher. We're up 11%, 11.8 on the S&P. If we just look at 2024, it's a very good market. I mean, annualized, we're looking at mid 20% return. And if we look at, 2023, it was like a 26% increase in value. So it would be nice to have it, but back-to-back years like that, that'd be really nice. We'll see if it happens. One thing I wanted to take a quick look at is the CNN Fear and Greed Index. And we are measuring at greed. I agree with that sentiment. I think that investors are pretty comfortable with the price increases on stocks. And that is uncomfortable for me. My comfort level is, the stock market is priced, I guess, fairly or accurately. And I think a lot of stocks are overpriced, especially as we get into the big stocks. And I'm going to go into my watch list, and I'll share with you what stocks I think are overpriced. They're some of the mega caps. So that's where I think there is a lot of greed is in those mega caps. So I'll get into that. All right. So just to lead off, I'm going to start. I don't think I've ever shared my watch list on the live streams, but let's start there. So here's my watch list. I'm not watching every company on the stock market. It's humanly impossible to do that. But these are companies that for one reason or another have caught my attention over the last, call it 5 years, and had kind of remained on my watch list. And some of these companies I owned and now don't own. I don't own any of these companies, but I just like to watch them. I evaluate the companies. I calculate what I think their intrinsic value is, and I put them on this list. CrowdStrike's a company that I've, kind of tracked, but especially looking at their fundamentals, I just think it's really overpriced. I've done videos on Tesla. You can look on my channel, and I think Tesla is incredibly overpriced. And I'm not the only one out there saying that. Moving into semiconductor, TSM, I did a video recently, I call it a month ago, and I used to be a TSM stockholder. I did really well at TSM. It's a multi-bagger for me, and then I sold it. It just became too expensive, and the market cap's really high, and I just cannot get TSM to rise up to the value where their current stock price is. So I think it's really overvalued. NVIDIA, it's a really, really positive story, but overpriced. And I give them a valuation where it's very favorable. Like, I believe in their growth. I believe in their revenue growth, but I just think it's overpriced. Microsoft's an incredible company, $3 trillion market cap. I believe it's overpriced. I owned Amazon up until late 2023. It was a very good winner for me. I made a good gain on Amazon, and I sold, and it continued to go up. So was it a mistake? Maybe, but I did have a big gain on it. I guess I was wise enough to buy it, in the past, and held it long enough to make a really good return on Amazon. Broadcom is another one that I owned and I sold in late 2023. This one ran up really fast. And when stocks in my portfolio just go up really fast, and I cannot, value the stock, and I think that a lot of it is artificial, just hype, I sell the stock. And I would say on most occasions, that proved to be a really good idea. In the occasion with Broadcom, I don't know if it's a good idea or not. It's too early to tell, but I sold the stock and it continued to go up, probably another 20%. And again, what led me to sell Broadcom, and I sold like a $80,000 position, was that they pretty much like doubled in price very quickly, like in 3 months. And I'm like, wow, this is incredible. But why? Their revenue didn't go up all that much. Their free cash flow didn't really move. And it was all a perception or expectation that Broadcom is going to be a big winner out of the AI data center build out. That may be the case, but it could also not be the case. And if I have a gain in hand and I'm questioning whether it's going to happen or not, I'd rather take the money, bank it, have a realized gain, and then see what happens. To watch what happens is free. To watch what happens when I have a stock that I think is overpriced could cost me a lot. And in some occasions, it's been a mistake. On most occasions, it's been the right thing to do. DLR is a data center real estate investment trust. I was an owner of it. This one I would put in the category if it was a mistake to sell it. I kind of got rid of some REITs because of higher interest rates, and I sold this mid 2023, and it really rose. I probably sold it when it was like around $85 a share. It's really gone up. So that one's been a big winner for other people. Squarespace, I was tracking it before I was announced that they were going to be acquired. And obviously, they had good value because somebody else is acquiring them and paying a premium. I think Palantir is overpriced. Looks like we have a question. Clifford, thanks for asking a question. What's up with Zim, investor here? Hope we have a good week ahead. Yeah, I'd love to talk about Zim. It is a big week. They're going to do earnings on the 21st. And I believe they announced early. I'm in California, so for me, early in the day because it is an Israeli headquartered company. So let's go over Zim. Give me a minute to finish my thoughts on my watch list, and we're going to get on Zim. All right, so we are on Palantir, and that's where that is. I've been tracking other stocks as well. Now let's flip this upside down. Companies that could be discounted, and I'm not going to track Big Five because they just sold it. I think it was a very small cap that I lost a lot of money on. So this is an education company. Again, I don't want to cover that one too much. Vici actually own, and I think it's a good investment. I need to take that off this list. Midland States Bank. Banks continue to have some value in them. I own Citibank, and financials. It's a place where it's really worked for about 10 months. And I think it's going to continue to work because especially like insurance companies are making a lot of money. Banks are making a lot of money. Banks tend to not broadcast how well they're doing because they don't want the politicians to start to complain about how much money banks are making. But study their financials, and I think you might see some value. Yeah, so I got US Bank and Midland States Bank on my watch list. I own Citibank. I own Ally, which has a bank component to it. And I own Robinhood, which also has a bank component to it. So I'm good at financial services. And I think those are the big, ticket items that I'm going to cover on this list. We've had a couple questions around Whirlpool on my videos. Whirlpool is like a really good brand, just excellent brand. But the company has been troubled, for the last year. A lot of things, a lot of moving parts on that one. So I'm waiting to see what's going to happen with the company. Once they get on the right track, I'm good to maybe buy into Whirlpool. But I just got to wait and see how the company puts their business plan together and starts growing. I know they just acquired a company in Europe. All right, so let's let me catch up on comments. We are going to cover Zim, so let me catch up on some comments. PT, thanks for joining. Appreciate it. So let's get into Zim in a second, and then Bad Omen. So let's talk about Toyota. Toyota has done really well. We looked at it, I'm going to say a week and a half ago, and it looked great. So, but let's start off with Zim. And so the Zim stock, if we look at the 5-year, right, back a couple of years ago, we had those supply chain constraints. Shipping rates are super high, and then shipping rates went down a lot. And the market said, okay, then this stock is not going to make as much money. And it really sold off. But what I thought was interesting was, during that time of high, shipping rates, Zim was able to accumulate a lot of cash. They bought new ships that run on natural gas, and they're very efficient. So their cost to move cargo is less expensive than somebody else who has an old ship, and their cost to move that freight is more expensive. So I thought that was an advantage. It was a smart way to use, some of their cash. And the shipping rates began to rebound. We had, the conflict in Israel, caused, I think, shipping rates to go up. And overall, shipping rates are higher than what I expected. So having said that, I continue to have a good value for Zim. My value on the company is So I have them discounted at 60% at their current stock price. So even after they really have gone up, I think they've gone up like 80% in the last month. I still have them discounted. Now, that's a really fast rise, and it's really caught a lot of attention. If we look at, the interesting thing about the shorts were at like 32%, I would say 2 to 3 weeks ago. And now we're at 17. So the shorts have exited this position thinking they didn't want to be around for the earnings report. Because if the earnings on Tuesday are really positive, I think this stock can go up 20-30% in one day. If the earnings are bad, flip side, it can go down 20-30%. But I think the facts on the table, shipping rates have been better than were expected. This is a well-run shipping company. I think they were doing the right things. They've been doing the right things for the last 3-4 years. So I'm expecting, I think that they're going to have a good earnings report, better than what, especially a year ago, what analysts were thinking. A lot of, I always think it's interesting. Let's look at a couple factors, right? When you look at a stock chart like this, we look at a stock chart like this, and you go, okay, this company is really rising. This is the sign that a company is doing a lot of good things, a lot of the right things. Okay, great. This is a sign that, oh man, these guys are terrible. They're down 88%. The management team must be terrible. Their revenue must be collapsing, all these terrible things. And it is true, from here to here, revenue collapsed. And that was, I think, especially since the stock went up so much, I think it was warranted for the stock to come down a bit. But when we look at the actual performance of the company, we had the company go up. And then when we look at the quarterly, it's still going down, but it's higher than what was expected. And now the compares are going to be reasonable. Now, when they announce their, their first quarter of 24, they're going to be comparing against a year that it's at 1.3 billion in revenue. So if they come in at like 1.5, 2 billion, it's going to be like, great, they're growing again. So I think a lot of things are setting up for this stock to really do well, continue to do well. I really like the return on it. On Zim, I don't remember how much I'm up or down. So here's Zim. I'm up 74% on the stock, which is nice. I invested 9,600 into the stock, and my stock's worth a little under 17,000. So I'm good with the return. Nice work, Zim. And it's going to be an exciting week. And, this one here, as I invested in it, I don't know how you guys feel, but, I like picking up stocks that are, unpopular or misunderstood. This one's in the category misunderstood. It's like, guys, this is a well-run company. Yeah, they can't control shipping rates, but if shipping rates are just reasonable, not expecting them to be great again, like 2 years ago, they're going to be okay. So let's see how Tuesday goes. And, my best guess is it's going to do well. And I think there's some news here. Let's kind of take a quick peek. So we have, I think there are comments on, so Zim integrated to shed light on dividend. It's just saying that on Tuesday, investors are looking for Zim to talk about their dividend. Okay, understood. When we look at free cash flow from the company, let's look at the quarterly wouldn't make a difference. So free cash flow is $931 million. Okay, so again, that's another sign that I think the company's healthy. Is if you keep producing free cash flow, you're going to be all right. If your balance sheet's good and you're producing free cash flow, you're not going to be under any threat to go out of business. You're going to be fine. These guys continue to produce free cash flow, not to the levels of the years prior. I mean, look at these cash flow numbers, $5 billion a year. Now the company is valued at $2 billion. Incredible. Amazing. So that's my comments on Zim. I shared how many shares I own of Zim, and looks like Clifford, you're in. I got in at 50 and at 8. Yeah. Well, your shares at $8 are going to be doing well. Hopefully, at some point you start making money on that stock. So that's Zim. Getting back to, so any other questions, please pop them in the comments. Glad to cover them. All right. So there was another stock that we wanted to look at was Toyota. All right. So Toyota, they've done really well in the past year. And I invested into Ford, and man, Toyota was a really good move for whomever invested in it. Their dividend is a little light, but I mean, the stock price has done great over the past year. It was sold off in 2022, and in early 2023 was the time to get into this stock. The company, I mean, it's arguably the best brand in automotive, right? I happen to think they're the best quality car company out there, and their cars tend to sell at, I'm going to call it a premium when people buy them, because they have the expectation it's a good quality car. Well deserved. They've been doing it for many years, and they've been growing their business really well. I mean, look at this growth in Toyota. Just very, very good growth. It's a big, large company. This isn't Japanese yen, so we can look at growth rates, but I can't convert that into dollars very quickly. It's a very good growth. Looking at cash flow, I think this is where their free cash flow doesn't look as good as Ford to me, and that's why I didn't invest in Toyota. If you guys know in the comments any ideas on why Toyota stock is doing so well, what was the catalyst of the stock appreciating so much? Is it something that I'm not seeing, something that I underappreciate? Be interesting to hear that from you guys. So I think their balance sheet's really good. Overall, it's just a good company, and it might be a little late into buying, these shares, but the stock did really well over the past year. So thanks for the question, Bad Omen. All right, so we covered my watch list. Now, going into the week, again, I don't think there's going to be any big news, but coming back to, where we are, from an overall value of the market, we look at the last 5 years, it's just been a really nice, it's been a great time to be an investor. If you're one of the younger investors on the live stream, this is why you invest in equities, is because, you're going to see some times that look like, oh my God, stocks are the worst thing in the world. I bought a stock here and now it's worth, half of what I invested. Oh my God, I made a big mistake. What you got to understand is you just keep putting money into the market. If you're young, starting your career, or maybe middle of your career, you're 35, 45, you keep putting money in the market, because over a long-term view, you're going to win. You may not win every single month, every single week. You may have a negative, period of time. Like this was a really negative 3-4 months. This was like a negative year in 2022. But if you keep putting money into the market, especially around these periods, you're going to win. You're going to win the battle, the war of having a really big portfolio. Waking up when you're 50 and going, cool, I got a really solid retirement. My kids want to go to college, no problem. They can go wherever they want. Want to buy a new car? Boom. If that floats your boat, you can go pay cash for it. So if you're one of the younger investors, this is why you invest in stocks, is to get that growth. I could be 90 years old. I will always invest in growth stocks, because I know this is the winning recipe over the long haul. Having said that, for the past, I think the upward trajectory started in late 2022. And from that point to now, we're up 48%. Awesome. For the past year, we're up 26%. And year to date, we're up 11%, close to 12%. So overall, I think we are in an expensive market, no doubt about it. And we'll see how things play out for the next 6 months. All right, got a comment from Bad Omen. It's going to start Roth IRA, I think, getting BOO and BTI. Let's take a look at those. I'm going to start with the one that I'm unfamiliar with. So BTI. So BTI is the Vanguard Total Stock Market Index. Let me get more details on what that has. This is a large blend. Okay, so large equities. Okay, it's kind of tracking with the S&P. All right, and I know what the other one is. So I think the answer I'm going to give you hopefully is useful to you. This is the Vanguard S&P. So this basically tracks the S&P. So if you're saving up and you're and it's an IRA, so I imagine you're like saying, hey, put $200 a month or $500 a month or whatever it is, and then it accumulates, right? And you can have an automatic investment in a particular stock. It's not a bad idea to go into the S&P. It's not a bad idea to have it automatically invested. What I would encourage you to think about is constantly try to get better each month, if not each week. I think investing in the S&P is not a bad idea, but I could tell you probably for many years, for 20 years, I probably had more of my investments in ETFs, mutual funds. And I would kind of track the market as a whole, like, hey, where's the economy? Where's the market going? Okay, great. And in some ways, I would actually, like, I remember after 9/11, the market really went down and I poured in money. And, I think that was a good idea. It turned out to be a good idea. But as I got older and I became more capable as an investor, investing is very personalized around you. Nobody knows you better than yourself. You know exactly, hey, these are the things I like to do. And when I retire, I want to do those things. Or I have family, I have kids, I have 4 kids, I have 2 kids, I have, a special needs kid. So all these things to me are really important aspects of the overall strategy in your investing. Your investing needs to be personalized around you, your family, the things you care about, the goals you have. Hey, I want to buy a house in 10 years and so forth. Having said that, as you save up your money in an IRA, 401k, or even outside of that, and you do it through a brokerage and you just have, you put money in that brokerage account. Maybe when you have a big deal go down and you made some money, or each month you put money into it, you really try to learn to get into investments outside the S&P, an ETF like this. For example, if you're saving up for, let's say, something you're going to want to buy in 5 years, a house, a new car, a kid's going to graduate and you want to send them to college, something's there. You're going to retire in 5 years. Okay. Fixed income becomes a really good idea because the stock market, as I'm showing you, can go down. If you said, hey, I'm going to retire in 2023 in the springtime, and then the market goes 10%, that's really uncomfortable. Okay. And that just happened less than a year ago. But if you go into an ETF that's fixed income right now, you're going to make 5-6%. If you go into individual bonds, you can get individual bonds that are going to pay you more than 5%. Some are upwards of 10-12%. So make it very personalized around you. It's a great idea to save. If the question is, should I save or not save? It's a very binary, recommendation on my part. Always save. Always save more than 10% of your money that you earn or more. It establishes a lifestyle that you could always live within your means because you're living off 90% or less, and you're constantly saving. Okay, so we got to the point of fixed income. Now, outside of the S&P, individual stocks, or maybe even more sector-driven ETFs, right? The S&P covers all things. But if you study the economy, and maybe there's certain industries and sectors that you have an information advantage on. Maybe you've worked in a particular industry and for example, let's say you worked in financial services. So you understand, hey, I understand financial services for insurance. I worked at an insurance company for 10 years. That gives you a big advantage. So maybe you can kind of go off and buy an ETF that's very focused around companies you understand. And then the next step would be buy some insurance companies that you really understand and believe in. Follow a process that you can keep learning. So investing in the S&P or a large cap ETF is a great idea. If the question is whether to save or not save, always save and put it there, and as you get more informed, more capable, you learn, maybe you're ready to go into sectors and industries and invest in an ETF. And maybe you're ready to get into some individual stocks. The thing that you got to prepare for as you go kind of like deeper and deeper into this investing, meaning individual stocks, is you got to be prepared mentally and emotionally for especially the down periods. The down periods are terrible. And if you bring, like, let's say, like, I'm married, got my wife, got my kids, and I don't want them to worry. So I kind of shelter them from any kind of adversity in the stock market. But I've been battle tested for 30 years. I dealt with like 9/11, the market crashed. We had COVID, market crashed. .com bubble, market crashed. And one thing that was a great thing I did was I actually leaned into those periods. I ended up putting more money than I had previously put the year prior. And I leaned into it. I sold nothing during those periods. And that ended up being a really good plan. The people that sold at the beginning of those crashes, we can chart it. I could show you. They lost 20-30% of their overall portfolio and never recovered it. But if you just hung in there, you would have recovered what you lost. And if you put more money into it, you took advantage of a market that was full of fear and people were selling off. So good luck with that, Bad Omen. I think you're on the right track. All right, so let's take a look at, no big economic news. And the stocks that, I continue to buy into, and I think all these, there's videos on my channel. So if you want to understand, what I'm doing in each company and why I think, the way I'm thinking, you can take a look at videos. But CBS is one where I continue to study their financials, and their financials show a company that is doing really well. They're growing their revenue. They're got great free cash flow. Just the market does not like CBS. They think a lot of bad things about the company. So I'm going to lean into it and buy more shares. Starbucks. The Mr. Market does not like Starbucks. It's sold it off. It's down 40-50% from its height. And this is the number one premium coffee restaurant. They make a lot of money on their coffee products, and I'm glad to buy Starbucks at a discount, and I'm going to continue to lean into Starbucks and buy more shares. Pfizer is beginning to work, and Pfizer pays a nice dividend, and it's beginning to work. If you look at the Pfizer stock chart, probably the last couple of weeks, it's gone up quite a bit ever since they announced their earnings. I think they turned that corner, and their compares are much more reasonable. So I expect big things out of Pfizer, and I want to load up on Pfizer. Comcast is a new position. It's been beaten up. It's been thrown away by Mr. Market. Doesn't like it. I appreciate their value. I appreciate their free cash flows. I appreciate their fundamentals. I am buying into Comcast. Really nice dividend. And I've invested into Comcast over the years. And this is kind of a swing trade where it goes up and down. And it was up. I sold it, waited, and I didn't think it was going to come down, but it's come down so much that I'm like, hey, let's do it all over again. Load up on it. Market realizes it's really valuable stock. It goes up, and we'll do it all over again. Nike, number one apparel company. I have a stock on it. A video on this stock, and good company to own. I'd like to load up on Nike, and then this one, I could see myself owning it for the next 20 years. So I'm going to buy big on Nike. The other ones, I'm not eager to buy tons of shares, but I think Intel is going to be worth a lot more in the future. Allstate's been really working for me. I'm going to keep buying in Allstate. Cigna, I think, is going to do really well. Part of the healthcare industry. Prudential is doing great. This is one of those old school, everybody forgets about Prudential, but I love their dividend. I love their appreciation. The stock's got a lot more to go. I think their compares are really good because the two previous years weren't the greatest. But now when you compare against those years, it looks really good. PayPal, I think, is going to start to work. This has been a hated stock, continues to be hated and probably questioned and by a lot of analysts. It seems like every time they cover PayPal, it's like, okay, guilty until proven innocent. Let's go over PayPal, and they go over all the bad things about it first, which I think has a negative sentiment around the stock. But I look at their financials and I think it's really discounted. So I'm going to keep buying into PayPal. I already have a pretty big position in it, and I'm going to buy more. MPW is a company that's really rallied in the last month. It's been up and down, but overall it's rallied. So I'm going to keep buying into that. And then Robinhood, I really like this company, and so do a lot of investors. It was up big this week. My only problem with Robinhood is the stock's price is going up too fast. So it's hard to buy stock when it's going up that fast. But I'm happy to see the stock really rise quickly. So those are the stocks that I'm really working with. I'm not planning to sell any particular stock. I continue to question myself and say, hey, what stock could I sell and create some more cash? Because I think the market's priced really high, and I can't get there. So I'm not going to force myself to just sell a stock just for selling a stock. But I'm going to continue to analyze companies. I tend to analyze companies twice a quarter just to keep up with the information of what's going on with the company. Make sure that something doesn't surprise me and I'm like, whoa, I should have sold that 3 months ago or 4 months ago. I want to stay current. Or maybe I see something that other investors don't see, and I buy more shares so that I can ride the wave upward when everybody else finds out the information. So that's my buy list. So I think that's the content that I wanted to cover. If there's any questions or any other companies you guys want to take a look at, I'm happy to do so now. To let you know, next Saturday, I'm going to interview a fixed income guru. He really likes to look at fixed income, but he also invests in stocks, but he has a different way of thinking. I thought it'd be interesting to kind of go over his process, his analysis with the community. And you guys could kind of hear one more person's kind of approach to valuing companies and then investing in them. He's a little older like myself, and I think it could be a really, really good conversation to listen to get an idea or two to make you a little bit better investor. All right, good stuff. So thanks for the questions, guys. Let's take a look at PT. How about CVS? Let's take a look at CVS. So CVS, obviously, I think most people know that it's a retailer of pharmacy supplies and medical supplies and so forth. And a lot of people are familiar with the CVS brand for that business. They also have two other businesses that are probably less known. One, they're a healthcare payer, and other people would call it a health insurance company. So they sell policies for healthcare insurance primarily to employers, and then they pay for claims on that health insurance. So that's interesting. And the other thing they're doing healthcare services, providing like urgent care, visits. So, hey, I've got a headache, can you take my temperature and all that good stuff? And yeah, you know what? You're probably gonna have a cold or a flu. Let me prescribe something, and you're there at the location. The reason I point that out is it's just not purely a retailer. These guys are beginning to really vertically integrate. And what that means is they are doing multiple things in that healthcare experience for people. People, obviously, they go to the doctor and then they get prescribed something and they end up at a CVS. Well, CVS is saying, hey, let's take a greater portion of the overall experience that these patients are going through. So we'll sell them the health insurance, we'll give them some of the health services, and we'll sell them their prescriptions. Perfect. So I like that strategy. It makes them different. This is a well-operated company, especially if you compare them to Walgreens. These guys are way better. I used to own Walgreens. I switched over to CVS. The market cap's $72 billion, and they do $360 billion of revenue. So you're paying for a fraction of their revenue. So this is $72 billion. When we look at their free cash flow, they're doing $10 billion in free cash flow, and that's a down year. In previous years, they were like 13, 15, 13. At $10 billion of free cash flow, they are doing about 13% yield of free cash flow on their revenue. That is a great metric. If you looked at any other company, any other industry, you'd be like, wow, that's a really valuable company. So that's one thing I'll point out. Their free cash flow is excellent. So good job, CVS, on your free cash flow. From a growth perspective, they've been growing. So you go year over year growth, they're growing. You look at their latest earnings release, they're growing. So what gives? They're growing, which means their customers like CVS. They keep going back to buy stuff or get services, or they like their insurance with the company that CVS owns. All those things are positive factors that lead me to believe the company is operated really well, and it's in good demand from customers. That's great. Their balance sheet's in good shape. Their debt to EBITDA, this is incorrect. I calculated to be around 3, which is reasonable to me. Their dividend is a solid dividend, and it has a payout ratio of 46%. Dividend yield of 4.6%. They do buybacks. There's a lot of things for me to like in CVS, and I think it's a misunderstood company. As we look at year to date, they had an earnings, and I believe the earnings were frowned upon because they were not, overly enthusiastic about the future. They actually were setting expectations down, and the stock sold off. So I reevaluated the company, and I decided to buy more shares. I recorded a video, and what's interesting is the video I recorded in the last 30 days, that's gotten the most views. So I'm not the only one that was interested in CVS. And so there's a lot of interesting things happening at CVS. I'm a buyer. I'm buying big. If I have to sit on the money for a little while, I get paid a nice dividend. But I think we're going to be sitting here in 2 years, and this stock's going to be much higher. So that's what I think about CVS. What do you think, PT? Please comment. All right, so looks like I got a comment on CVS. So yeah, CVS outlook. So the insurance members, so the outlook on insurance members went down over the next 2 years. Yeah, that could affect the company. Good point. Okay, what about CLOV? Clover Health. So Clover Health provides Medicare Advantage plans in the United States. It operates 2 segments, insurance and non-insurance. It covers Clover Assistant, cloud-based software platform. All right. So this is insurance and then non-insurance. So it does it's a healthcare payer and then it provides a software platform. Okay. They are a small cap, 441. I guess it would be a micro cap. We'll see what's going on with their net income, but their revenue is really high compared to the market cap. Good. Analysts say, hey, it's really discounted, but we're holding on the stock. All right. The revenue really went down. Huh. That's a big drop in revenue. For the quarter, the good news is the quarter, if you compare Q1 of 24 versus Q1 of 23, it's up 7%. That's good. But that number was down 63% from the previous year's quarter. So what's going on here? What causes big drop in revenue? That's a question, that has to be answered in my mind before I'd even consider investing in this company. The free cash flow. So for the quarter, it was 25 million. For the year, it looks like they burned some cash in the past year, but they are back on free cash flow footing for the first quarter of 24. So this one here, I mean, the reality for me is I can find 100 small caps that look like this. And I've invested in a number of small caps, and those have underperformed for me. I've been disappointed. It's no secret, the Magnificent Seven, the big caps have been a majority of the gains that we've seen in the stock market. And so I would be very cautious in looking at this stock, making sure I understood what was the big drop in revenue caused by, and what's the story to get them to a better place. They're a really low price stock. That's also a giant concern. When investors look at a stock like this, they're afraid it's going to go out of business. So getting the market to like this stock is going to be tough. So there's a lot of concerns around this stock here. And I think with healthcare, as a sector, healthcare was left behind in 2023. It didn't perform as well as obviously like technology or communication services. It actually underperformed its average return. If you look at the return for healthcare for the last 10 years, it's top 3. It's right up there, especially like biotech. It could be considered like a technology space where those companies just get priced really high because they grow so fast. Well, in 23, healthcare didn't perform very well. So in my mind, there's a lot of upside potential with healthcare companies. So back to Clover, I think there's a lot of choices in healthcare that I'd rather look at before I looked at this one. I think there's a lot of money for me to make in healthcare before I have to take the kind of risk that a Clover would cause me to take. Thanks for the question on that. And it's from Sayan. Thanks for the question. I appreciate it. All right. So it looks like you had some comments on it. They're pivoting to SaaS. They have a lot. So they're going from, hey, we were a healthcare payer, but now we want to be a tech company. That's interesting. So I like your comments. And Sayan, if you really believe in this company and you have kind of a greater sense of the company and you feel like, hey, I want to invest in this company and hold it for 5 years, I totally get that. I'm just not seeing it. And but if you see it, go for it. It's something that you may have a huge advantage. And if just as long as these guys make it, right? The thing you got to track as well is you look at what's their cash balance. So they have 236 million. See how it's been going down, right? 615, 334, 236. Okay. So how much cash are they burning per year? The important piece to it will be, and let's look at the quarterly. So it did go up. So it went up in the most recent quarter. That's very good. How much debt? 1 million in current, no problem. Long-term debt. Okay, no debt. That's very good. That's very good. Very good news. Now, in the most recent quarter, they are positive on the cash flow department. It's very important because if they were to do this for 2 years, they'd be in a lot of trouble because they would have burned through all their cash. So this can be really important to follow is the free cash flow and make sure that they're going to have the balance sheet to get them through this major pivot from, hey, we're going to be a health insurance payer to just a software company. I think it may be a really good idea because if you become a really successful software company, your valuation is probably going to be pretty good. But if they have enough cash to make the pivot, and again, you're getting this stock for nothing, for 89 cents a share. So the only direction it can go up is up. If they don't go out of business, the only direction they can go is up. So good little company to take a look at. I appreciate it. So Ken Griffin keeps adding shares. Interesting. Yeah. Big reason Humana is dropping in price is because companies like Clover. Interesting. Yeah, Humana's had a brutal 12 months. I just tip my hat to you that, you're willing to dive into a company like this, form a opinion on this company using facts and understanding their business, understanding what they're trying to do. You're doing fine. I would just encourage you that if you're going to go high risk, diversify, because it's kind of like if you bet on one company and you bet all your capital and they do great, you're like, wow, I'm a genius. Look at all the money I made. But if you bet on that one company and bad luck or the company didn't operate right and you lose a lot of money, oh man, that's painful. So diversify into several companies, 5 companies that are kind of, growth companies. And then if you get older like me, diversifying stuff that's less risk, if at all closer to zero risk, which is like treasuries. And then you can play with high risk stocks, but never be hurt like to the point where, oh no, I got to get on the top ramen and peanut butter and jelly sandwich diet. Nope. That's not going to happen. I'm going to diversify. So good stuff, man. Good luck. Please keep coming to the live streams. Keep coming with that type of information and passion. This is awesome stuff. Hey, Sergio, very nice to see you. And thanks for watching, and thanks for watching later. Appreciate it. Yep. So good point. If you buy it before the market realizes it, you could, stand to be a big winner. Just, on a high level, I think you're going to need to be patient on this one. But we'll see. I hope it works. I hope it works, and I hope you make lots of money on it. All right. So good stuff today, everybody. Good luck this week on your trades, on your investments. Let's see how the market plays out, and we'll see if we end up higher or lower. it's been a real positive market. But as I, I go on YouTube and I watch, especially the big fund managers, and I try to catch them on interviews where they're not like pumping a particular stock or anything. And I think the perception is that stocks are priced high, and it's getting harder for the bulls to make the case of, oh yeah, we're going to keep going up. We're going to keep going up. I think it's hard to make that case. You don't have as much, data to support that, but we'll see what happens. We'll see what happens over time. As I showed the graph with investing, you want to be an investor over the long haul, because we're going to have adversity. We're going to have days, or months and quarters and years where you have stocks really go down, but over the course of time, you will benefit from being in equities. They will grow faster than other options, and you'll really feel like you're keeping up or staying up with inflation and other things. When the market just gets on tears like this, where the market went from the bottom to the top and it pretty much doubled in value, you feel like you're doing the right thing when events happen like that. That's 106% gain from the bottom to the top. And then here, looking at the bottom that was reached, and it actually was reached in October 14th of 22 to now, it's 48%. You feel like, hey, I'm glad that I've got a lot of stocks, because my stocks are going up in value. It's, helping me grow my portfolio. That way I've got a bigger retirement. I got more money to, help my family with, just to have it to invest in real estate, to invest in cryptocurrencies, to invest in bonds. So I have a really nice bond ladder that has all my cash flows for the next 5 years covered. All those things are possible, but you gotta stay invested. You got to keep adding money. If you're employed or you run your own business, always put money away that you feel like, I'm not going to touch that money for the next 20 years, 30 years, 40 years. And that would be a very good habit. If you do that, you'll wake up with a big brokerage account at some point. All right, good session. Thanks so much for the comments, for the questions. If there's nothing else, I will end the live stream and wish you guys a very nice Sunday and a great week. Thanks, everyone.